This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bear channels. I want to begin by defining what I mean by a tight bear channel. In general, if the market's in a bear channel, and it's very difficult to make money buying, you know the channel is tight and you should only be looking to sell. A tight bear channel is usually a strong bear breakout on a higher time frame chart, and therefore, again, you should only be looking to sell. Sometimes when the market's in a tight bear channel, there'll be a bull channel lasting 5 or 10 bars, and it's almost always a bear flag. The market will have a bear breakout. But if the pullback grows endlessly, it becomes an endless pullback, and after 10, 20, or 30 bars, the odds start to become as likely that there'll be a bull breakout of the bear channel. And if you do get a strong bull breakout above the bear channel, the market becomes always in long. Any channel can be tight or broad. Here are a couple of bear channels. And I refer to this as tight. When a channel looks like this, the pullbacks are small, lasting only 1 or 2 bars, and they do not extend very high up in terms of the number of ticks. It's a tight channel. And when a channel is tight, it's very hard to make money trading against it. And therefore, if you're in a tight bear channel, you should only be selling. You should look for any reason to sell. However, when a channel has pullbacks lasting 5 or 10 bars, and bulls are able to make money buying with limit orders or even buying with stops, then the bulls are reasonably strong and traders will sometimes buy in addition to sell. However, it's still a bear channel, a bear trend, and therefore it's always better to sell, especially for swings. The bears will sell every pullback betting on a reversal down, and the bulls will start buying at new lows and reversals up for scalps. The bears are selling for scalps and swings. The bulls will buy for scalps only because it's a bear trend. They're not going to swing trade. When you look at a chart and you're not sure if it's tight or broad, these channels are fairly similar. If you're not sure if it's tight or broad, assume it's tight and only trade in the direction of the trend. The reason why I like to distinguish tight channels from broad channels is because I trade them differently. The tighter it is, the more I'm only going to be trading in the direction of the trend. Here, a tight bear channel, I only want to sell. On the other hand, if it's fairly broad, I will trade in the direction of the trend, but I may take scalps in the opposite direction. The math is much better for the bears when the channel is tight. Very difficult to make money buying when the pullbacks are small and only last a couple bars, 1 or 2 bars. The rallies are not going up far enough for the bulls to make money. Bears should sell and bulls should not be looking to buy, especially when it gets very tight like this. Let me give you some ideas on how to distinguish a tight channel from a bull channel. If the pullbacks only last 1 or 2 bars, here's 2 bars, here's 1 bar, here's a couple bars, 1 bar, then it's probably tight. I also always pay attention to the smallest scalp size, and in the E-mini, the smallest scalp size is 1 point. If the pullbacks are all less than 2 to 3 times as big as the smallest scalp, then I'm not going to be looking to buy. The smallest scalp is 1 point, and if the top of the pullback is only 2 or 3 points above the bottom of the bear trend, it's better not to look to buy. For example, if you were buying with a stop above here, it's very difficult to make a profit with a stop entry buying above the high of the prior bar because the pullback is not going to go up very far, and you're already buying fairly far up above the low relative to the height of the channel. I also pay attention to how big the pullbacks are compared to the size of the average bar. This particular channel, the average bar is 2 to 2.5 points tall. That means if the pullbacks are less than 4 to 5 points, I don't want to be looking to buy. Too difficult to make money. And that is the case here. The bars are averaging 2 to 2.5 points tall, and the pullbacks are not 2 or 3 times bigger than the average bar size. That makes it very difficult to make money buying. Traders should only sell. Here, this is an average bar in this particular day, and it's 10 ticks tall. And therefore, traders should not be buying unless you're seeing pullbacks that are at least twice as big as that, preferably 3 times as big as that. And that's not the case. The pullbacks are not 2 to 3 times the height of an average bar. I also pay attention to how far the pullback retraces the prior leg. Here we have a bear leg, and the pullback retraced about half of the bear leg. If the pullbacks only retrace 1/3 to 1/2 of the prior bear leg, it's usually better not to be looking to buy. Also, look at how profitable the buy setups are. Here we have a bull II, here we have a bull reversal bar for a failed breakout. Are the bulls easily making money, or is it very difficult to make money? If all of the stop entry buys are losers, even when there are reasonably good buy signal bars, then traders should not be looking to buy. Gaps are always important, and if you get a breakout and then a reversal attempt, and the reversal attempt cannot get above the breakout point, then the trend is strong, and that again makes it very difficult to make money buying. Think about it this way. You have bulls buying at the prior low, scaling in lower. They need the rally to come back above the breakout point for them to make money. They want to get out break even on their first buy and a profit on their second buy. But if the market never gets back above the breakout point, the limit order bulls buying at lows and scaling in lower are losing money. When a channel is tight, by definition, the pullbacks are small, and that makes it very difficult to make money buying. If you look at this and you say, boy, this is hard to make money as a bull, especially if you try to buy a couple times and you're losing money, that's telling you that you should only be selling. Instead of buying, every time you see a buy setup, you should look for where the bulls will get out and then sell exactly where the bulls are selling out of their longs. Every trend is always forming wedge bottoms. Here we have a bear trend, 1, 2, 3, tried to get a wedge bottom. Now we have another wedge bottom, 1, 2, 3. That's normal. Every bear trend is always forming wedge bottoms. Every bull trend is always forming wedge tops. However, when the wedge bear channel is very tight, the target for a reversal up is the top of the channel, which is right here. So the market's reversing up from the bottom of the wedge. The target is right here. If it breaks strongly above that, then the next target is the beginning of the wedge up here, which is not very far up. In strong trends, in this case strong bear trends, the bottoms all fail. And when a wedge channel is very tight, the odds are it's going to fail, not go up high enough for a profit, and instead the trend will keep working lower. Do not look to buy. You're always going to be seeing wedge bottoms and bear trends. Never look to buy a wedge bottom unless the swings are very, very big. Well, you can argue we are in a bear trend, we broke above the trend line, and now we have a lower low. And this is a lower low major trend reversal. Well, it might look like it, but it's not. Beginners are always seeing bottoms when trends are strong. Look to the left. If the pullbacks are small and the channel is very tight, these are not major reversals. They are minor reversals. And the best that you can hope to get is maybe a small trading range. It's too early to be buying. After you see a trading range, then trade it like a trading range. But until you get a big enough minor reversal for traders to convert the trend into a trading range, trade it only like what it is, and that's a tight bear trend. Only trade in the direction of the trend. Stop looking for reversals. The trend is too tight. You're going to lose money. This is not enough buying pressure for traders to be looking for a major trend reversal. The channel down is too tight for traders to be looking for a major trend reversal. Good looking buy signal bar, failed breakout of a trading range, reversal up from a wedge bottom, but it's a small pullback bear trend. That trumps any reason to look to buy. Failed breakout of a triangle, we have a wedge bottom, we have a good looking bull bar, but pull back only 1 bar, pull back only 1 or 2 bars, pull back only 1 or 2 bars. This is not a buy setup. This is a small pullback bear trend, and the reversal here at best will be minor, and likely the bear trend will continue. Beginners love setups like this. They're always finding reasons to buy in strong trends because the risk is small. They buy above the high of this bar and they know their stop is just below. They're not going to lose very much. What they ignore is probability. the probability of making money with a stop in a very tight bear channel like this is small. So they lose most of the time. They can say, well, at least I only lost a little. But if you lose a little here and lose a little here and lose a little here, at the end of the day, you'll have lost a lot. You cannot simply look at risk and say, okay, I'll take the buy. You got to look at reward. It's probably a minor reversal, so the reward will be small. And probability, the probability of making money buying in a very tight bear channel is small. And therefore, the trader's equation is terrible for the bulls. Again, you can't simply look at risk when you're taking a trade. You have to look at probability. Buying in a tight bear channel like this, very low probability of making money. And you have to look at reward. A tight bear channel at best is going to be a bear flag or a trading range, and therefore the reward is small. And that is not enough reward, despite the low risk, to offset the very low probability of making money. Do not buy, because the reversal will be minor and probably become a bear flag, another lower high in the tight bear channel. And this is what happened. You got a little bull bar, you got a second bull bar, and you ended up losing money, just like you did here and here and here and here all day long. You've been losing money. Not very much. You lost money here, you lost money here. You lose money all day long buying a small pullback bear trend, a trend in a very tight bear channel. You're taking this buy, but look what just took place. You have 6 bars down, no bull bars, maybe 6 bear bars. This might be a small bear body, might be a doji. But in any case, you have 6 consecutive bear bars. That is unlikely to lead to a bull reversal. So you have a very tight channel nested within a bigger tight channel. The odds of getting a major reversal out of this are very small. Who buys up here? Well, the bears sell pullbacks and they buy for partial profits at a new low. So some bears will buy here. And then you have weak bulls constantly looking for reversals, and they're buying and losing money. When the bears see that the bulls are unable to get the reversal, the bears sell again. And they do that all day long. Every reversal attempt, they sell, they sell, they sell, they sell, they sell. And that's what you should be doing as well. Now, I said that a tight bear channel is a breakout on a higher time frame chart. I want to talk a little bit about that. Here's the 5-minute chart of the E-mini, and this is a 120-minute chart, a 2-hour chart of this same thing. While on the 15-minute chart, there might be an occasional pullback, there's not going to be much. And if you look at the 120-minute chart, it's just bear bar after bear bar, and you have 4 or 5 bear bars closing below their midpoints, near their lows. When you look at this, you say, wow, what a great looking buy. I'm going to buy here, I'm going to buy here, I'm going to buy here. Of course not. You're getting consecutive big bear bars. The odds are any reversal is going to be minor and fail. Therefore, anytime you have a tight bear channel, the higher time frames will be in breakouts. And if you're in a strong bear breakout, you only want to sell. Therefore, on the 5-minute chart as well, you should only look to sell. This red box on the 2-hour chart is this red box on the 5-minute chart. And a tight bear channel is always a higher time frame bear breakout. And you should trade it like a breakout and only look to sell. Channel is a very tight breakout on the 2-hour chart. Only sell. If you look at a chart and you're not sure, well, maybe we're getting enough buying pressure so that we'll get a reversal up. If you're not sure, look at a higher time frame. Or simply decide that if you're in a bear trend and you're not sure if you should buy, do not buy. Whenever you're not sure about whether to buy in a bear trend, the answer is do not buy, only sell. Here's a breakout. There's no confusion. It's going lower. Here's a bear channel. It's constantly getting pullbacks, and that generates confusion. It makes the shorts slightly lower probability. If you're trading this chart, there's no thought involved. You sell for any reason. You know the market's going lower. On this chart, there's a little bit less certainty, so the probability of the shorts is a little bit less. However, it's far better than the probability of the longs. Does not look like much of a trend, but it is a trend, and the reward is big. If you find yourself repeatedly buying and losing money, take a look at the higher time frame chart. And if you see 2 or 3 consecutive bear bars closing below their midpoints, closing near their lows, stop buying. If you want, you can trade the higher time frame chart, for example, and just sell closes, sell that close, sell this close. If you do, the correct stop is above the top of the current strong bear breakout, which is up here. And that's far, it's about 10 or 12 points up. If you can trade small enough, then it's reasonable to take the short. You might be able to get a tighter stop on a 5-minute chart. For example, after 5 or 6 bear bars, if you sell for any reason, you can put your stop above that high or above this high. When the market's in a tight bear channel, sometimes there'll be a pullback that's in a fairly tight bull channel. It's usually a bear flag. However, if it grows to 10 or 20 bars, you have to be watching for a possible strong bull breakout above that bear flag, which would convert the bear trend into a bull trend. Whenever you have a bear trend and you get a reversal, it's usually a pullback, and it leads to a resumption of the bear trend. At some point in here, you're going to decide that the bear trend is in a fairly tight bear channel. Therefore, it's very difficult to make money buying, and traders should only look to sell. You can call this a tight trading range, you can call it a slight wedge, doesn't matter. It's a tight bull channel or a tight trading range. This is clearly a small, tight bull channel lasting about 4 bars. There are pullbacks in a bear trend. The odds are the trend is going to resume, and traders should only look to sell. For example, you can sell on the resumption of the bear trend. You can sell on a stop below the bear bar. Here we have a micro double top. You could sell below this doji, or here, now we have a micro double top. This is a higher probability sell. You place a stop order to go short 1 tick below the low of this bar, and you get filled right here. Sometimes you'll get a bull channel in a bear trend, and the bull channel just keeps growing. And at some point, it can reach 10 or more bars. You can call it a pullback that is endless. I call it an endless pullback, and it can often be the start of a bull trend, or at least the end of the bear trend. If the bear trend has some kind of a climactic sell-off, and if there's a strong reversal up, and then you start to get an endless pullback of 10 or more bars, especially with big bull bars, it's probably not going to be a bear flag. It's probably either a bull leg in what will become a trading range, or a very strong minor reversal that will lead to a major reversal, like a higher low major trend reversal, and then a second leg up. The two things I look for are, was there some kind of a sell climax leading up to this bull channel? And did the bull channel have 3 or more consecutive bull bars closing above their midpoints, especially if 2 or more of the bars have pretty good sized bull bodies? And this is the case here. If I see this combination of things, 3 or more bull bars and some kind of a climax, here we got a small parabolic wedge, I begin to think that this might be the beginning of an endless pullback. The channel down is tight, and therefore this is not a major reversal. It's a minor reversal. However, it can be a minor reversal that could, in fact, become a major reversal into a bear trend. It could be an endless minor reversal, an endless pullback. And if I see some kind of a sell climax or parabolic wedge, and especially a reversal up that has 3 or more decent bull bars, traders start to think that instead of a resumption of the bear trend, instead of this tight bull channel being a bear flag, it could be the start of a bull trend. Initially, the probability still favors the bears, but once you start to get 3 or more decent bull bars, especially big bull bars, the odds are the bear trend has ended and the market has become either a trading range or a bull trend. Bulls are going to be looking to buy. For example, a second entry buy with a good bull bar closing near its high, bull bar closing near its high, and then we got 3 consecutive bull bars, bulls will buy the close. We have a pullback, an II bull flag, not much in terms of big bear bars. The odds are we're going higher. Traders will either buy on a stop above the II or on a stop above a strong bull bar, expecting to make at least some profit on a resumption of the trend up. I talk more about this on the videos on tight channels and micro channels, pullbacks and bar counting, and major trend reversals. Here we have a bull trend, but then look at this. we have a tight bear channel. If you have a tight bear channel in a bull trend, it's probably a bull flag, and it's more likely that you'll get trend resumption up than trend reversal down. If this grows to 20 or 30 bars, then the probability for the bears rises to about the same as for the bulls. But if the pullback is 5 or 10 bars, it's a pullback. A pullback means the trend is likely to resume, more likely than to reverse, and therefore it's a minor reversal into a bull flag. We have a very tight bull channel here, and therefore the best the bears will probably get is a minor reversal, which means either a bull flag or a trading range. Good breakout on the part of the bulls, breakout of this trading range. I would call a trading range like this that is small a pullback in a bull trend, and it's likely to have a bull breakout. Even though there's a tight bear channel, it's not enough bars to make the market always in short, and therefore you look to the left, it's still always in long, more likely that will go higher. The market's in a trading range. You can call it a triangle. 3 pushes up, 1, 2, 3. Lower high here, slightly higher high, but basically a triangle, higher lows, marginally lower highs. In any case, we have consecutive bear bars, so at this point it's probably always in short again. It was always in short, probably always in long, always in short, always in long. Triangles are always doing that. By the time you're always in short, it's going to reverse up and become always in long. By the time you're always in long, it's going to reverse down and become always in short. Anyway, we have a double top, lower high after a reasonably strong leg down. And at the close of this bar, it's always in short again. The context is good for a swing down. You can call it a triangle or a trading range. Now we're getting a breakout, and we have a double top. We have a pullback, but a bad buy signal bar here, and the pullback reversed into a bear bar. It looks like we might be in the early stages of converting into a bear channel. The trading range could continue all day. It was still a trading range at this point. It was also a bear channel. We were getting lower highs and lower lows. Very often, a trend exists with a channel, and you don't know which will ultimately win until many bars later. If we only look at this point from here to the left, it's still a trading range, but it's also still in a bear channel, an early bear channel. We have a bear breakout and we have a pullback, but the bulls were unable to get good looking bull bars. We're sideways. The bulls here did not do enough to make it always in long, and therefore you look to the left to find the last time there was clarity, and that was here. So it's always in short here, and this is not enough to make it always in long, and therefore it's always in short. That means it's slightly higher probability to go down than to reverse up. When you're looking at this, you say, oh, it went up 3 or 4 bars, sideways for a lot of bars, went up here for about 10 bars from this low. Is it tight or broad? Well, if you can't tell, it's usually better to assume that it's tight and only trade in the direction of the trend. Trade it like a breakout. It's probably a breakout on a higher time frame chart. And because it's a trend, you can swing part of your position. However, because it's mostly sideways for a lot of bars, a lot of the bears will simply scalp. Every time it goes up, they'll sell, and when it gets down near the prior low, they'll buy, and that causes these repeated pullbacks. For the bulls, I don't know that it's worth buying, especially after a big bear breakout like this and a follow-through bar. Chances are, whatever rally we get will be a lower high followed by another leg down. Again, decent looking bull bar, but following a 6 or 7 bar bear microchannel and a bear breakout and a follow through bar, probably a minor reversal to a lower high. The bulls have a double bottom, but a bear body. They have a bull II here, but pretty high up and not much buying pressure, so probably just part of a bear flag. Here we got a failed breakout to a new low, but an extremely tight channel for about 15 bars, plus the market's still always in short. Weak buy signal bar, don't buy. Now you can argue parabolic wedge, a reversal, close above the midpoint, but 4 consecutive bear bars, I would not take that buy. And then here, another bull bar, the bull's hoping for a higher low, major trend reversal, bear trend, bull breakout, higher low, a high 2 buy, high 1, high 2, good looking bull bar. Not enough bars for a major reversal. We only went up 4 bars. probably a minor reversal, which means either a trading range or a bear flag. It turned out to be a 1-bar bear flag. The bears won. It's a double top bear flag. After you get a double top bear flag, you have a 40% chance of a swing down, and the bears got it. And usually when it does start to turn down, it's always looking like it's going to reverse up and form a higher low, a head and shoulders bottom, left shoulder, head, right shoulder. But 40% chance you're going to get a swing down. We're getting lower highs, pretty good sell-off, reversal not strong enough to make it always in long, and therefore bears will look for any reason to sell. Some bears will only scalp until it's clearly bearish, but some bears will swing part just in case it's a bear channel. If it is a bear channel, it could last a lot of bars. Now, it's a pretty tight bear channel, and some traders would also call this a small pullback bear trend, which is a very strong type of trend. A small pullback bear trend always looks like it's about to reverse into a bull trend. It looks like a bear leg in what would become a trading range. However, it tends to form gaps. The pullbacks are small, they do not go up very far, and that makes it very difficult to make money as a bull. You should only sell. So what do you think about this? We're down about 30 or 40 bars. Pullbacks are only a few bars tall, very tight channel, and therefore if we do get a reversal, it probably will only be minor, and followed by at least a test back down here, more likely a resumption of the bear trend. Whenever you look at a chart like this and you say, gosh, it's going down, but gosh, it's really not strong enough for me to be selling at the low. I'll wait for a pullback. Whenever you have that anxious selling, that's your radar telling you that you have to get short, and therefore just sell at the market. Look to the left, find out where an appropriate stop is, maybe above the top of this bear leg, and then just hold on. Whenever you're desperately hoping for some kind of a pullback so that you can sell higher and have a tighter stop, that means the market's probably going a lot lower and you should sell. A lot of times you'll have multiple choices for a stop. So if you sell here, do you put your stop here? Do you put your stop here? Did you put your stop here? Does it go up here? Well, I would not use a stop that's too tight. There are often several possibilities for a reasonable stop, like above here, or above here. If you use a wider stop, less likely to get hit, so higher probability of making money. But when it does get hit, you'll lose more money. This is probably not a reasonable stop, but this probably is. Whenever you're in a tight channel, it always feels like the market is constantly at the low. And therefore, if you want to sell, you're always selling at the low. The market's always forcing you to sell too low. It always feels like the trend is not all that strong, therefore it can reverse at any time. But because the channel is very tight, any reversal is probably minor. And therefore the risk of a significant reversal, the risk of a loss, is small. The easiest way to enter when you're feeling that way, when you're feeling like, oh my gosh, I need a pullback, I don't want to sell at the low. The easiest thing to do is just sell at the market. You just trade a very small position and sell at the market. If you get a pullback, you can add to your position. If it goes straight down, you'll make a profit. When you have several choices for stops and you're not sure which to use, I would tend to use one of the further ones, certainly one of the middle stops. If you don't want to risk all the way up here, and if you think this is too tight, then choose one of these stops. I personally would not choose this one. The breakout to the downside is not strong enough to make this a major lower high. This is a more major lower high. So let's say you chose that stop and you put your stop above the high of the bear breakout. Let's say it goes above that stop. Well, if it goes above the stop and reverses down, you can always sell again. When a channel is very tight like this, a reversal into a bull trend is very unlikely. Usually the best the bulls can get is a trading range. And then once it's in a trading range, then they might be able to get a reversal. For example, a major trend reversal. But until then, traders can sell at any point for any reason, expecting that any reversal will be minor and that the odds are very high that the market will come back to their entry price. So for example, if you sold here or here, you got a bounce. It still went back below your entry price. If you sold here at the very low, It rallied against you for 5 or 6 bars, but the odds were high that it would come back to your entry price and probably go lower. Remember the market cycle. A tight channel is a very strong trend, and therefore the risk of a reversal is small without first entering a trading range. And that means the risk of a reversal up here is small without the market first going sideways at least 10 or 20 bars. If it goes sideways 10 or 20 bars and you sold this low, and then you concluded it was in a trading range, the odds are very high that you could get out break even, especially if you scale in higher. The odds of losing money are small. One of the key things is no matter where you sold or for whatever reason you sold, you have to rely on your stop as long as you believe it's still in a small pullback bear trend. The first reversal up has a very high probability of forming a lower high and testing back down, and that will allow you to exit with either a small profit or a small loss. The odds of losing much money when you're selling, even at the absolute worst price at the very bottom, are small. Still always in short. Even with these bull bars, it's still always in short. And as I said, the best the bulls can reasonably hope to get in a very tight channel is either a trading range or a bear flag. Here they got 2 legs up, 1 pullback 2, and therefore a low 2 bear flag. The market remained always in short, and the bulls will get out below a bear bar in a low 2, 1 pullback 2. If they make 2 attempts to go up and both fail, and then they see a bear bar for the low 2 sell signal bar, they'll sell below its low. And because the bulls will give up after 2 attempts to go up, the bears will sell there as well, and you'll probably get another leg down. In this particular day, the market stayed always in short all day, but that's not always the case. Very often when you have a very strong bear trend, in the final 30 minutes, the final hour, the bears will take profits, and you can often get a sharp rally, a deep pullback. And therefore, when you get near the end of the day, if you see any kind of a reversal, it's reasonable to take profits. Here we get a second entry buy at the low, so it's reasonable to get out here, just in case this is the start of profit taking, which could go up to this high or even higher. We're starting to get dojis. We're probably not going much lower. Here, the market fell 5 or more points at the end of the day, but that's unusual. This is an extremely big day, and that's why the bears were able to make 5 points. 5 points in this particular day is not big relative to the size of the day, and I think it's reasonable to get out here, a second entry buy, new low, with only a half hour left to the day. Now we have a wedge late in the day. It never triggered, and therefore the bears who did not get out here would not get out there. So it's okay to hold on to shorts. However, they would get out above a bull bar or a second entry buy here at the end of the day. Can you sell at the bottom of a breakout? If this were a strong breakout, a series of consecutive big bear bars, you certainly would sell that. We have dojis here. We have a bear bar and then a doji. The bars are not all that big. So it's not as strong as a typical breakout. However, it's clearly always in short. Therefore, traders can sell at the close of this bar, taking a chance that we trend down. The probability of a profit is high. We have about 10 bars and a pretty tight bear micro channel with only a single bull bar. So the probability is we'll get at least a small second leg down, and therefore the probability of making money is high. But so is the risk. We have a bear breakout, another bear breakout, and the stop is up here. So yes, the probability is high, but so is the risk. Let's say you sell at the bottom of a channel. The probability of a profit is not quite as high, and usually the risk is not as high as well because the leg down is not as strong or big as in a breakout, and therefore the stop is usually not quite as far as it is in a breakout. This breakout is not terribly dramatic, but a lot of breakouts are extremely big, and the stop can be very far away. Here, we have less probability of making money selling down here compared to here. This is a breakout. Even though it's not strong, it's slightly higher probability to make money than down here, but the risk is a little bit less. This is really not a good example to illustrate my point. If I had a chart where there was a very, very strong bear breakout, the stop would be very far and the probability of making money would be very big. Here's a breakout, but not very big. However, the risk is further than selling in a bear channel, and the probability of making money is greater. I gave my definition of what a tight bear channel is, and if the market's in a tight bear channel, it's very difficult to make money buying. You should only look to sell. A tight bear channel is a strong breakout, a bear breakout on a higher time frame chart. And again, you should only be selling when the market's in a breakout. Most of the time, you'll get small, tight bull channels within the tight bear channel, the bear trend, and they're bear flags. However, if you get an endless pullback, if the market pulls back 5 bars and then 10 bars or 15 or 20 bars, instead of it being a bear flag, it might be the start of a bull trend. You have to be watching for a series of consecutive bull bars, and especially a strong bear breakout with follow-through before you decide that you're getting a bull breakout above the bear flag and that the market is turning into a bull trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading tight bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading tight bear channels. I want to make an important point in this video, and that is that if the market's in a bear trend, especially a strong bear trend like a breakout or a tight bear channel, reversals are usually minor, which means they usually lead to bear flags or possibly trading ranges. But the odds are the bear trend will continue. At some point in here, everyone agrees that the market is in a tight bear channel, in other words, a bear trend. The market keeps trying to reverse, and every reversal is followed by lower prices. That means every reversal is either a trading range or a bear flag. And traders should be looking to sell reversals, not buy reversals. Even if a seller happened to sell the lowest close in the trend at this point, the risk of losing money is small if he manages his trade well. By managing a trade, I mean using an appropriate stop, and the probability of making money is higher if a trader can scale in, because any reversal is probably going to be minor and lead to a test back down to the low of the bear trend. If a trader were to sell here, he would put a stop above the most recent major lower high, and this is a major lower high. We have a series of bear bars and a new low. Is this a major lower high? I don't know. It's not that dramatic. There's not much selling. It's 3 bear bars. If you did put a stop here, I think it's probably a minor high, and you can see the market went above it over here, yet the bear trend resumed. Whenever you have a strong bear trend, in this case a very tight bear channel, the market usually has to become a trading range before the bulls have a chance at reversing it, creating a major trend reversal into a bull trend. And therefore, there's very little probability that an appropriate stop is going to get hit. Most reversal attempts fail. Tried to reverse, tried to reverse, tried to reverse, did not hit the stops. As I said, I think this is a fairly minor lower high. The rally is not all that strong. The sell-off is just a few bars. They're not particularly big. We have bigger bars here, here, here. Therefore, this might lead to a trading range or a bear flag, but probably not a bull trend. You can see this rally broke above the top of the bear channel, but it's only a few bars at this point. At this point, it's maybe 6 or 7 bars, and not particularly strong. Therefore, if we form a higher low, especially if the higher low comes from only 4 bars down, it's probably part of a trading range and not a major trend reversal. The bulls tried 3 times to reverse the bear trend, and none of the reversals was enough to convert the trend to always in long. It remained always in short, and therefore you can look at this as a trading range or as a bear flag. Usually, if it's just a few bars, I call it a pullback, a bear flag. And here we have 2 legs up. It's still probably a pullback, a bear flag. Once it gets to be about 20 bars, I tend to use the term trading range. However, the odds still favor trend resumption down rather than trend reversal up. There's just not much buying pressure. The rallies are just not strong enough to make traders believe that the bulls actually can take control and create a bull trend. No clear major trend reversal pattern, and no wedge bottom, which often leads to a major reversal. Therefore, only a 30% chance that any one of these reversals will lead to a bull trend. 70% chance the reversals will be minor and lead to bull legs in trading ranges or simply become bear flags. Bear flag. Here, it's a bear flag. Still probably a bigger bear flag, like a double top bear flag. At this point, I would call it a trading range, but not much buying pressure and still not enough bars to make the probability the same for the bulls as it is for the bears. The probability still favors trend resumption down. A reasonably strong bear breakout to a new low, a series of 4 bear bars. One of them is pretty big. I would call this a major lower high. As long as the trend is continuing to make major lower highs, the trend is in effect. If the market starts to go above major lower highs, then it's no longer a bear trend. It's then either a trading range or possibly a bull trend. As I said, we have a new low and 3 bear bars, but they're not particularly big compared to the prior breakouts, and therefore this is not a major lower high, it's a minor lower high, and that increases the chances that we're going to go sideways. This is an acceptable stop, just a little bit above the top of this lower high. If you get stopped out and the market remains always in short, you look to sell again, either here or here. In general, if the market's always in short and it rallies, and let's say you exit for any reason, let's say you exited above this bull bar after a lower low, it's still always in short after these 6 bars, 7 bars, and therefore always in bears will look to sell again below a bear bar that closes below its low. That would be below this bar, and they would get filled right here. A lot of bears prefer to use the top of a major lower high for their stop. And some of these bears, if they sell here and they see the market rally for 6 bars, 7 bars, they'll add on. They'll sell more. They'll look to sell below a bear bar and get filled here. They'll take the second entry as long as it's at least 2 or 3 times bigger than the minimum scalp. In the E-mini, a minimum scalp is 1 point, and therefore the bears will sell more below a bear bar if the second entry is 2 or 3 points above the first. Sometimes it's 5 or 6 or 7 points above the first, but as long as the stop has not been hit, traders will add on. The goal is to get out break even at their original entry, and then with a profit that is at least as big as the minimum scalp on their second entry. It has to fall below that first entry to get filled, so most of the bears who sold this close and or below this bear bar did not get filled here. It hit their limit order price but did not fill. A lot of those bears would then get out above a bull reversal bar for a possible double bottom higher low. Even though it's still probably minor, not enough bars down for a major reversal, a lot of the bears will get out and then look to sell again below another bear bar, for example here. You do not have to get out here because this is still a minor reversal. 7 bars up, not moving up all that far, not consecutive big bull trend bars, not much buying pressure. And then the test of the low is only 3 or 4 bars, and that's usually not enough for a major pattern. It's usually too small for a major trend reversal. Usually it's a minor reversal in a trading range. However, it's reasonable to get out because there's probably better than a 30% chance that we're going a lot higher. And then you can always sell again when the bear trend resumes, if it resumes. Very tight bear channel. And on the next higher time frame, a 15-minute chart or a 30 or 60-minute chart, it's probably just a series of bear bars closing on or near their lows. It's a breakout on a higher time frame chart. Very strong bear trend. The pullbacks are all very small and only a few bars. Traders should trade it like a breakout. Only sell. You cannot make money buying when a trend is this small and the pullbacks are this small. You can argue that we're in a trading range here, but once you have a decent sized breakout with a decent follow through bar, a bear bar closing near its low, the market's probably going down for at least a measured move and possibly a bear trend for the remainder of the day. The market's always in short. the odds are it's going at least a little bit lower. How do you enter? Simplest thing to do is right around the close of that bar, either a few seconds before or a few seconds later, you just hit sell the market and put your stop just above the top of the sell climax or maybe above this lower high. You can also sell above any bar, betting that reversal attempts will be minor and they'll fail. And anytime you see a bull close and attempt to reverse the trend, the channel is very tight, the reversal attempts almost certainly fail, and therefore you can sell bull closes. Or if you prefer stop entries, you see a reversal attempt like this, and you see bad follow through, a bear bar on the next bar, place a stop order to go short just below its low, right here. Another bull breakout attempt, and then a bear bar, you sell on a stop right below its low. You get filled right here. The bulls who bought see that they're not getting consecutive big bull trend bars breaking far above the top of the bear channel. They have a second attempt here, and the bear trend is resuming a second time here. The bear trend tried to resume here. The bulls got one more leg up. If the bear trend is resuming a second time, usually the bulls give up, and that's one of the reasons why low two shorts are so reliable in strong bear trends. Where do you put the stop? Is it reasonable to put your stop right above the breakout? Well, if this is going to be the start of a bear trend, it should not go above the top of this 2-bar bear breakout, and therefore it's reasonable to use the tight stop or even a tight stop here. The most recent major lower high is probably here at the start of the bear trend, but these are reasonable. In general, any reasonable stop is good, and if you take this trade 10 times using a tight stop versus using a wider stop, your total profit will be about the same. You'll lose more often with the tighter stop. However, the few times you do lose with the wider stop will be about the same as the total losses from the tighter stop. Any reasonable stop is appropriate. Once you decide that the market's always in short, then you believe the market is going down, and that means you have to get short, at least a small position. And as I said, the easiest way to get short is simply sell at the market. We have a pullback, and once you have a pullback, the market is then in a channel phase. We have a bear microchannel, no pullback here for about 7 or 8 bars, fairly tight channel, and now we're reversing up. The first pullback will almost certainly fail, and the market will go at least a little bit lower. Once you get a pullback in any kind of a breakout, here we have a strong bear breakout, and still follow through, no pullback through these 3 bars. Now we get a pullback, so for me, that's the start of a channel phase. Obviously, the channel began up here. We have a breakout in the channel, and then another pullback. So we have a breakout here, and then a resumption of the bear channel. We had a bear channel, and then a bear breakout, and now the channel phase is resuming again. Another bear breakout, strong enough so that we'll probably get at least a small second leg down, and we obviously got another 50 or 60 bars down. Again, if a trader is flat and he did not go short, he can sell the close of that bear bar. We have a bear breakout bar closing below its midpoint, and then we have a second bear bar closing on its low. It's in general not best to sell at the bottom of any channel, but it's reasonable. This is a very tight bear channel. It's a breakout on a higher time frame. The odds are we're going lower. Again, the easiest way to enter, if you're flat and you're wondering what to do, you find out where your stop is. That determines your risk, and that tells you what position size you can take, and just trade small and sell at the market. Either you can wait for this bar to close near its low and then just sell at the market and get filled on the next bar, the open of the next bar, or just sell a second or two before this bar closes. Whenever the market's in a bear trend, one of the first things I always look at is whether or not the limit order bulls can make money. If a bull buys at a prior low and scales in lower, will the rally go above the breakout point? That would allow him to get out break even on his first entry, and then with a scalper's profit on his lower entry. And look, we have a gap. And here we have another gap. This market is not allowing limit order bulls to make money, and therefore it's a very tight bear trend. It's a small pullback bear trend, and the odds are it's going lower. However, once the bulls can start to make money, then I call it a stairs pattern, and that increases the chances that the market will soon evolve into a trading range. Whenever there's a breakout and then a bar trades above the high of the prior bar, that's a pullback. And I always assume that the market is in the early part of a channel. If there are stairs, in other words, breakouts that pull back beyond breakout points, that is another sign of two-sided trading. And instead of a breakout, which is one-sided, the market now has some two-sided trading. It's probably in a channel. Here, we have a breakout below this low. And the top of this pullback is above the breakout point, that low. And therefore, this is a stair step down. That's a good sign that the breakout phase has ended and the market is now in a channel. This pullback is not enough for limit order bulls to be buying. This channel is still far too tight, and bulls should not be buying. However, it's one sign that the breakout phase has ended and the channel phase has begun. Whenever you look at a chart and you believe it's a trend, for example, somewhere in here, you have to conclude that the market's in a bear trend. Then you know that there's a 60% chance or more that the market will go lower, at least a little bit lower. Whenever you look at it, you say, well, where are all the big bear bars? These bear bars are fairly small. The market keeps reversing. Maybe it's not really a bear trend. Maybe it's a bear leg and what will become a trading range. However, you look at how tight it is and you can see a gap between this low and that high. And then we get gaps between this high and this low. The market is strongly bearish. You know it's going lower. It never feels like 60 or 70% chance of making money. But when a bear channel is this tight, it is 60 to 70% chance of making money, entering at any time for any reason using the appropriate stop. Here, we got 3 consecutive bull bars. Maybe the trend is reversing. No, the channel is still very tight, and therefore any reversal, even 3 consecutive bull bars, is most likely minor, and it will be followed by a resumption of the bear trend. When you're watching this real time, it's easy to get frightened. Oh my gosh, I'm short and it's going to take my money. It's going to hit my stop. Well, the reality is the odds of that are small. Any reversal is minor. Until after there's a big minor reversal, the odds of the market converting into a trading range or a bull trend are small. What about the probability for the bears? I said the probability is high that it's going lower. Well, when you start having pullbacks like this, the probability of lower prices is not quite as high as when you have a strong breakout. However, it's still very high. Also, because of the pullbacks, there's less time pressure. That gives you more opportunity to trade. In other words, do I sell here or do I wait a few bars? It doesn't matter. You can wait a few bars and see that a couple legs up are not reversing the trend. Then you can sell a low too short below that bear bar. No matter where you short, if you're trading this on a higher time frame chart and you see that it's a breakout, no pullbacks, your stop is up here. If you're trading it on the 5-minute chart, your stop might be there or here. So the risk is about the same as for a breakout. The reward, usually a little bit less because you're getting pullbacks, and that means the trend is a little bit weaker. However, the risk reward is still good and the probability is still good, and traders should short. The biggest problem that you have is the evolution of a channel into a trading range. Yet, even the first reversal up, if it's very strong, it's still minor, which means you'll still probably get a chest down and the bulls will probably need a major trend reversal, some kind of a double bottom. Here, it's a higher low, could be a lower low. And at this point, we don't know if it's going to lead to a major reversal. However, this is such a strong bull breakout that the odds are we're going to get a test back up here. And the bear channel has now evolved into a trading range. Trading range means it goes up, it goes down, and then it tries to go up again. Whenever you have a bear channel, there's a 75% chance that eventually you'll get a bull breakout and the market evolves into a trading range. 25% chance you'll get a strong bear breakout and then an even stronger bear trend, starting the market cycle over again. Bear breakout and then channel down. Once you look at this chart at the end of the day and ask yourself, where did the trading range begin? You say, well, it's actually been sideways for a whole bunch of bars, like 60 or 70 bars. We're still in a bear trend, still in a bear channel. But once you have this strong rally and then you see it going sideways here, you look back and you'll discover that actually it was also in a trading range here. And even though this is still part of the bear channel, this part of the bear channel was a bear leg in what became a trading range. We have a breakout to a new low, just lasted one bar, and then you get a pullback. As trends go on, they tend to become weaker and they tend to evolve into trading ranges. And there are signs that the process might be beginning. For example, if the breakout just lasts one bar and then we're starting to get a bounce, it might be weakening and it might soon evolve into a trading range. If limit order bulls buying at that low and scaling in lower can make money, does this pullback go above the breakout point? That's another sign that it might be evolving into a trading range. A brief breakout, again, brief breakout, and another reversal. So these are all signs that the market might be evolving from a channel into a trading range. The bears are starting to see bars with fairly conspicuous tails on the bottom. And that means at the end of the bar, traders are buying. That makes it likely that the bears are getting weaker and the bulls are getting stronger, and the market might be evolving into a trading range. Also, you look at the follow through, you get a series of bear bars and you start getting bull bars after the bear bars. Here you get a bear bar and then a bull bar reversing it, a bear bar and then another reversal, a bear bar and then a doji and a bull bar, a bear bar and another reversal. Traders are starting to buy after the close of strong bear bars. Instead of selling and getting consecutive bear bars, they're starting to buy. That means traders are buying low, and that's one of the signs of a trading range, buy low. Bear bars, not particularly big, so instead of a series of big bear bars, we were getting bigger bear bars here earlier in the trend during the breakout phase. Now we're getting a series of bear bars, but they're not quite as big. Also, they're shrinking. Look at this body, a little bit smaller, and now even a bull body. Lack of momentum as the market's getting lower. Lack of interest in selling as the market's going lower. Lack of consecutive big bear bars. Big bear bar and then a doji bar. Big bear bar and then a doji bar. Instead of a big bear bar and then a bear bar. All through here, it's still a strong bear trend. And you can sell the same setups that you would during a breakout. You can sell at the market, you can sell bear closes, you can sell bull closes. The odds are high that we're going lower. However, as it begins to weaken and becomes more two-sided, traders start to sell only rallies instead of at the market, even at new lows. So what's the big difference between a very strong bear trend and a breakout? In a breakout, traders will sell at prior lows, betting that we're going lower. In a channel, they start to buy at prior lows to take profits and then sell rallies around the midpoint of the prior bear leg. So once a trend starts to weaken, instead of just selling at new lows or at any time, traders prefer only to sell pullbacks. Instead of selling as the market's going down, breaking out to a new low, it's bouncing. So traders are starting to take partial profits at new lows. When the range is fairly big, the bears don't necessarily take profits at the prior low. They might take profits 1, 2, or 3 points below the prior low. However, the bears are still buying at the low, and the result is you get a rally that goes above the prior low. The bears do not want to sell down here. They want to take profits here. The bears want to sell higher. So there's nobody to sell here. The bears are buying, the bulls are buying, and the result is a rally. It's still a bear trend, and therefore the bulls are unwilling to hold on to longs. They're buying and scalping. They're buying down here, scaling in lower, and taking profits up here. And the bears are selling somewhere in the middle of the most recent bear leg. So down here, bulls and bears are buying, and then up here, both bulls and bears are selling. The bulls are selling out of longs, and the bears are selling back into shorts. Down here, bears are buying out of their shorts to take profits, and the bulls are starting to buy for a scalp up. That's a sign that a channel is transitioning into a trading range. Earlier on, when the channel is very tight, any bull buying at the prior low with a limit order is failing to make money. That's a sign of a fairly strong bear trend. If bull scalpers cannot make money buying at prior lows and scaling in lower, that means the market is very strongly bearish and probably going lower. When the channel is very tight like this, most bulls will not buy. Most of these little pullbacks are caused by bears taking partial profits. I wanted to make the very important point in this video that whenever the market is in a tight bear channel, reversals are minor. That means they become bear flags or maybe small trading ranges, and the odds are high that the bear trend will continue. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading tight bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading tight bear channels. If a channel is not particularly tight, sometimes bulls will buy and scale in lower. I think it's very important to pay attention to whether or not the bulls can make money. If it's difficult for the bulls to make money, you should not be buying. You should only sell. The market broke out a series of bear bars and then it pulls back. As soon as you pull back, then the market is in a channel phase. So a spike, pullback, and then a channel. Even though this is very, very tight here and it's a breakout on a higher time frame chart, on this chart, I would call it a very tight bear channel within a larger tight bear channel. What's happening here is that every new low, bears are taking partial profits, taking partial profits, taking partial profits, and that's causing pullbacks. And inexperienced bulls are buying above all of these bars and losing money constantly. They're buying because the risk is small, and beginners only think about risk. They don't think about probability. When the pullbacks only last a bar or two and do not go up very far, it's virtually impossible to make money, and therefore traders should only sell. Once the bears start to see little pullbacks, they begin to sell pullbacks and take profits at new lows, and the result is you keep getting small pullbacks. You have inexperienced bulls buying below bars hoping for a reversal, and they keep getting trapped. Or they'll buy above a bull bar betting on a reversal, and they keep getting trapped. Not enough buyers following them, and the market continues down. Most bulls, most experienced bulls, are unwilling to buy these reversals because they know the pullbacks are only lasting a bar or two and do not go up high enough to make money. Nobody's holding on to longs for swings up, and nobody's buying more higher. Therefore, these buys are all terrible, and in fact, if anything, you should be looking to sell exactly where you see buy setups. The pullbacks are too small. A small pullback bear trend, a very tight channel, you should only sell. When a channel is tight, every reversal is probably going to be minor. Until you get a very strong minor reversal, you have to bet that every reversal is going to be minor. Even the first strong reversal probably is minor, and the bulls will need a major trend reversal, a test back down to the low, and then a reversal up from there. This is a minor reversal. Every one of these reversals is minor. This is a very strong minor reversal. When you finally get a strong minor reversal, then the bulls will start looking for a swing up. Every bear trend is constantly forming wedge bottoms. Every bull trend is constantly forming wedge tops. A wedge bottom does not mean that the reversal will be major. When the wedge is this small and the channel is this tight, it's a minor reversal, and it'll lead to lower prices. Every new low, you can keep redrawing wedges. So 1, 2, 3. You break to a new low, 1, 2, 3. It doesn't matter. When the channel is tight, wedges are not reversals. They'll lead to bear flags and not bull trends. On a smaller time frame chart, this is a 5-minute chart, but on a smaller time frame chart, you can look at this and say, it's a wedge bottom, and we're getting a bear breakout below the wedge bottom, 75% chance you'll get a reversal up to the top of the channel right here. You might be able to trade it on a 1-minute chart. I would recommend against it when the 5-minute channel is this strong. However, on the 5-minute chart, remember, the target from the reversal up from the bottom of the channel is a test of the top of the channel. If you're buying on a stop above the high of this bull reversal bar, you're already at the target. Realistically, it's probably not going to go much above your entry price, and therefore you're probably going to lose money. In addition, whenever the market is in a strong bear trend, you should not be buying at all. Some bulls will start buying with limit orders when you start getting pretty good size minor reversals. However, you should never be buying with a stop order when the market is in a tight channel, because the market is only going to reverse up for a bar, maybe 2 bars, and not high enough up to make money. Remember, it's a small pullback channel. Pullbacks are small. If you're buying with a stop, you're buying reasonably far, relatively far above the low, and odds are it's not going to go much higher. Every breakout becomes a channel, and every channel eventually becomes a trading range. And sometimes when a market starts to enter a trading range in a very tight bear channel, bulls will start to buy new lows and start to scale in. Because when you start to get bigger pullbacks and more frequent pullbacks, the odds are the market will soon begin to enter a trading range. And if it's in a trading range, bulls can begin to make money by buying lows and scaling in lower. For example, we have a double bottom, 2 bull bars here, 2 bull bars here, and we have a micro double bottom here. We went up again. We're starting to get some two-sided trading. Some bulls will place limit orders to buy at the prior low and scale in more lower, and then use a wide stop, maybe a stop based upon a measured move down from this, maybe a little bit more than that. For example, the bars here are maybe 4 points tall, reasonably big bars. Instead of adding on 1 point below this low, a bull might buy more 2 points below, and then more again 4 points below, and use a wide stop. Normally, you might risk 4 or 5 points, but when the bars are big like this and the range is big like this, you have to risk maybe double that. And instead of scaling in 1 point below, 2 points below, with the bars big and the range big, you maybe scale in 2 and 4 points below. Some bulls will buy 2 or 3 times this way. Would they buy 5 or 10 times this way? No. And if you're going to have to scale in 5 times, you have to assume that you're buying in a strong bear trend, not in a bear leg and what will become a trading range. You have to assume that you're going to lose money. So let's say you bought here and then scaled in a couple times and used a stop 10 points down. How does the math work out? Are you going to let this stop be hit? No, you're only going to be using this stop as a catastrophic stop. You're buying because you believe the market is going to go into a trading range and that new lows are going to come back above breakout points. We broke to a new low, went above the breakout point. Broke to a new low. You're betting that this breakout eventually will come back above this breakout point. But you know it could fall a number of bars first. You're going to use a wide stop. Again, you're not planning on letting that stop be hit. However, it's a catastrophic stop, just in case the market keeps going down, or in case you lose electricity, or in case something happens and you have to run out and handle a family emergency. You want to have some stop there to avoid a catastrophe, in case the market just kept selling off all day. These scale-in bulls know it's in a bear trend. However, they're hoping that this is a sign that the market is transitioning into a trading range. And it did. It did become a trading range. It took a lot of bars before it became clear, but some bulls will take a buy here, buy more 2 points lower, 4 points lower, and then place a limit order to get out at their original entry. They get out break even on their first trade, 2 points profit on their second, and then 4 points profit on their third. These bulls who bought at this low, 2 points lower and 4 points lower, ended up with a total of 6 points profit. On the other hand, if their stop was hit, and let's say they bought more 2 more times, so let's say they bought a first entry, a second entry, a third entry, a fourth entry, and then their stop was hit, they would lose a total of 28 points. That means these scale-in bulls, the bulls who were buying and scaling in lower, were risking 28 points. It turns out in this particular case, they made 6 points, but they were risking 28 points. And how can the math possibly work out for that? You need a positive trader's equation to take a trade. Scaling in increases your probability, which is good, but it also increases your risk. However, you probably need a probability of 80% or more to risk 28 points and end up making only 6 points on the trade. You pay for a great probability trade with bad risk reward, which usually means the reward is small and or the risk is big. In this particular case, you get both. You have a small reward relative to your risk, and the risk is relatively large. Now, how can it work out? Well, if you're using that wide stop, most of your losses are going to be less than 28 points. Sometimes you'll take the buy at that low and it will immediately go up and you'll make 2 points immediately. Many of your winners are going to be more than 2 points. You might decide to hold on and maybe make 4 points or 6 points. Also, if the market's going down, a lot of times you will not scale in if you think the market is clearly always in short or strongly short. For example, if you have 3 strong bear bars closing on their lows, the odds are the market's going lower and you will not take the second buy, and you might in fact exit the first buy with a 2-point loss. This is a very tight bear channel, but if it's a very broad bear channel, a skilled trader can win 90% of the time in a situation like this, and his average win might be considerably bigger. It might be 8 points, 6 points. Let's say it's 8 points. If he takes 10 trades and he wins 9 times, that would be a 72-point total profit. If he gets one loss, remember I'm talking about winning 90% of the time in a broad channel, his one loss of 28 points is far less than his gain of 72 points. In a tight channel, that's not the case. In a broad channel, it's much easier to scale into longs and make money. It's much, much easier. The probability of making money is much greater, the rewards are bigger, and the risk is smaller. In a tight channel, traders often enter and they quickly get disappointed and then they exit around break even. For example, let's say you bought this low and the channel is very, very tight. You bought more here, you bought more here, and you're thinking, gosh, this is worse than I thought. And you decide that instead of trying to get out break even on your first entry and with a profit on your second and third entry, you'll find your average entry price and just try to get out at your average entry price, and you'll be exiting to avoid a loss rather than to make a profit. The average win scaling in a tight channel might only be 2 to 4 points. In this particular case, even if you win 90% of the time, 80% of the time, you're barely making enough money to make it worthwhile. Even great traders will rarely buy below bars and scale in when the channel is tight. That's the exact opposite of what you should be doing. You should be selling above bars, betting that the reversals will fail. However, if you are able to do it and use the appropriate stop and scale in, and the risk is not greater than a size that you can comfortably lose, then you can do it. Theoretically, it's possible. In the real world, it's a bad idea. You have to do it perfectly just to make a little amount of money. And if you do it anything less than perfect, you're going to lose money. So it's a bad strategy. So do not buy lows when you see a tight channel. I always pay attention in a bear trend to whether or not the bulls can make money. If they can make money, then the bull trend is probably transitioning into a trading range. And then I will start to look to buy low, sell high, and scalp. In addition to selling, obviously, if it's still in a bear trend, I want to be selling, but I can also add buying as well. If a bull bought this low and scaled in lower, his stop is going to get hit. He lost money. If he buys any of these lows and scales in, he's probably going to lose money. If he bought this low, he'd get filled here. He was able to make a scalp. Some of the bulls would therefore buy additional lows. With 2 or 3 big bear bars, I would not do it. But if a bull did it and used a wide enough stop, he would avoid a loss and he probably could make money, at least in theory. This is a strong enough minor reversal and went back above the breakout point to make bulls start buying prior lows. They'll buy this low for a scalp up. They'll buy this low for a scalp up. A bear breakout, but the bars are not all that big. And after the bear breakout, we got a bull bar. And then we have a second bull bar here closing on its high. And we're getting tails below bars and we're getting reversals. Bear breakout, reversal. Bear breakout, reversal. So two-sided trading, the breakouts are getting weaker, a sign that the market might be transitioning into a trading range. I would say this is not easy for the bulls to make money. Buying here, buying here, buying here. However, if I did not buy, which I would not, and then I see the bulls ultimately did make money, and that's the second time they made money buying this low as well, then I would start thinking that the market is probably transitioning from a tight bear channel into a trading range. And in addition to taking shorts, I'll start looking to buy at prior lows. The bulls know the market's still always in short. All the way through here, it's still always in short. But the bulls are now starting to make money, and that's a sign that the market is transitioning into a trading range. Bear channel, very tight. Now, if you buy this low, maybe you'd make a little scalp. If you buy this low, it looks like you'd be trapped. There's a gap between this high and that low. Buy this low, maybe you'd make a little bit of money. Buy this low, you're trapped. Very difficult for bulls to make money, even scaling in low and using wide stops. And whenever you look at the market, let's say you just turn on the screen right here. First thing you look at, you say, well, it's a very tight bear channel. I only want to sell. You might say, well, maybe I can buy, but let me first see if it's easy for bulls to make money. And you start seeing gaps. The pullbacks are only 1 bar, 1 bar, 1 bar. Very difficult for bulls to make money. And because it's difficult for bulls to make money, you should not try to buy. You should only be selling. Especially, you should sell every attempt to reverse up, betting that they'll fail. Here, if a bull bought this low, it turns out he could make a 1-point profit. And maybe you'd have to risk a few points to be safe, but he did theoretically make money buying at that low. Let's say a bull, therefore, buys at this low right here and scales in lower, 1 point lower, 2 points lower. It had to go above the breakout point, his original entry, for him to get out break even on his first trade and with a profit on his second and third entry. But look what it did. It reached his entry price at that low and did not go above it. And therefore, he could not get out break even on this trade. And if it starts to turn down, he'll get out, like maybe below the low of this bar, which is a loss on this entry, a profit on this entry, break even on this entry. He'd get out, basically break even on the trade. However, he did not make money, and that is a warning to anyone looking to buy. Stop buying. Bulls are getting trapped and not making money. If the market is over here and I turn on my screen for the first time and I look at it, one of the first things I'm going to look at is whether or not the limit order bulls are making money scaling in below prior bars. And when I see that they're trapped, I know the market is probably going lower. So I'm only looking to sell. In actual fact, theoretically, if a person did buy at this low, they get filled here, buy more 1 point lower, buy more 1 point lower, he would have had a 1-point loss. If he get out here below this bull bar, he would have had a 1-point loss on his first entry, a 2-tick loss on his second, and a 1-point profit on his third, and his total for the 3 entries would be a 2-tick loss. If you're thinking about buying and you start looking at the screen over here or over here, you look back at things like this and you say, boy, it's really difficult for the bulls to make money. You have to conclude that the bears are very strong and you should stop trying to buy. If it's too difficult for the bulls to make money, you can see these bulls only made 1 point, these bulls lost money, we're getting gaps, we have a gap here. Do not buy. As a bear, the market's clearly in a bear trend. I'm a bear. I'm looking to sell. I also want to pay attention to whether or not the bulls can make money. And if I see the bulls having a very difficult time to make money, and if I see them losing money, that makes me more eager to sell. So if I'm flat, I have to get short, and I'll sell for any reason. The odds are, if the bulls cannot make money, we're going lower, probably quite a bit lower. The bulls at this point saw how hard it was for the bulls earlier to make money, and therefore they become unwilling to buy. And the result is the reversals are very small, and we have to go down a lot more before the bulls will find a price low enough that they'll buy. With fewer bulls willing to buy, the chance of a bear breakout becomes higher. Again, a bull buying at this low, scaling in lower, barely made money. He made a 1 point scalp on his second entry, break even on his first. We only got a 2 bar pullback. Eventually, the bulls stop buying. It's repeatedly very difficult for them to make money. And if the bulls stop buying, you can quickly get a bear breakout and follow through. And once you get that, you're probably going to get at least a small second leg down. Maybe leg one, pullback leg two, very tight channel. More likely leg one, pullback leg two. That's the minimum goal. Some bulls who bought here might hold, hoping for a test of this lower high or that lower high. But if they did, look what happened. We have a low one. This bar fell below that bar's low. And now we have a low two. Not only a low two, but the sell signal bar is a bear bar closing on its low. Any bull who bought for any reason, if he sees a low two and a very tight bear channel, and the sell signal bar is a bear bar closing on its low, the bulls are going to sell. The bears see that as well, and they're going to sell. And with the bulls and bears selling, pretty good chance you'll get a breakout and a profitable trade. That's one of the reasons why low two sell signals work so well, especially in very strong bear trends. The bulls give up. They'll hold for one attempt to resume the bear trend, but they will not hold for a second, especially if there's a strong bear bar closing on its low. Why do we have this big bull bar closing on its low and then a follow through bar? Because some bulls continue to hold and they're giving up. This is the final bulls giving up on these bars. You have a breakout and follow through. The bulls are giving up. The bears will sell, betting that any reversal up will be minor and will get at least a small second leg down. The bulls are selling out of their longs on these closes, and the bears will sell those closes as well. Now, I said the odds were we'd get a second leg down, one pullback, two. You might get 3, 4, 5 legs down, but at a minimum, you're going to get a second leg down. And because of that, some bulls will look to buy a reversal up from that second leg. Now, what do these bulls do? Their thought is, okay, there were limit order bulls who bought below this low. I don't have them indicated here. They're confident that eventually we'll get back above this low, even if we go down a long way. Some of these bulls will buy more above a bull bar, betting that it'll be the start of a reversal back above this breakout point, and then they could get out break even on their first buy right here, and then with a profit on their lower buy. Here's a bull bar. Are they going to buy above this bar? No, because we just had a bear breakout, and the odds are we'll get a second leg down. After a second leg down, the bulls who bought at this low will buy above a bull bar and then try to get out break even on their first entry, which they were able to, and then with the scalper's profit on their second. Other bulls who did not take any of these buys know that scale in bulls will buy above this bull bar, 2 legs down and a bull bar. And these bulls will also try to get out around that low. And guess what? The bears know the bulls who bought here and scaled in lower are going to sell if it gets back there. And the bulls who only bought here and not earlier are going to try to get out at that low as well. And therefore, the bears will sell here because they know the bulls are selling, and the bears will try to scalp a short. A bull reversal bar, bull bar, terrible for the bulls. They're losing money. really hard for bulls to make money, even buying with limit orders. Eventually, the bulls stop trying. They know that when it's that difficult to make money, the market probably has to go lower before enough bulls will be willing to buy. As I said, to make money, they often have to scale in repeatedly, and then the profit is small and the risk is big. And most bulls do not want to trade like that. That's terrible math. You have to do it perfectly or you're going to lose money. Very few people are perfect all of the time, and therefore it's a terrible strategy. It's a losing strategy, even for really good traders. So that's not how experts trade. They do the opposite. They're selling. Whenever they look at their chart and see that it's very difficult for bulls to make money, the experts are only looking to sell. Let's say you're a bull and you bought for any reason. Let's say you bought at this low. You're planning on getting out maybe after 2 or 3 consecutive bear bars, especially a new low with a big bear bar and then a follow through bar. Well, one thing you could do is you could say, okay, if I get that bear breakout and follow through, I'm going to reverse to short. So I buy at this low, get filled over here, and at this point, I know that I'm wrong, and I'm going to reverse to short, and it'll fall at least the same distance, and I'll be able to get out and erase my loss. I'll make as much as what I lost. It sounds good in theory, and it usually theoretically is possible to do. What's the one flaw? Even experienced traders do not like to reverse. It's hard to quickly change your evaluation of the market. Emotions get in your way. You don't feel objective. And even experts rarely do it. I sometimes do it, but I do not like to do it, and I rarely do it. Now, I'll go back to what I've said countless times. When a channel is tight, only look to sell. Another reason for that is the buying strategies are losers, and you're going to get out. Theoretically, you could reverse to short and make up for the loss, but you're not going to do it often enough, and the result is you'll end up losing money. We have a bear breakout and we have follow through, and now we're channeling down. This is a bear breakout on a higher time frame chart. The odds are high that we're going lower. So you're thinking about getting short. The first thing you always have to determine is where a reasonable stop is. You have several choices. So let's say the market is right here and you're thinking about getting short. You know it's a very tight bear channel. We're probably going lower and you're going to go short. Reasonable stops, maybe above the top of the current bear leg, maybe above the top of the bear breakout, maybe above the top of this bear trend. This is a major lower high. All are reasonable. If you sell here, you choose any of the reasonable stops. You know what your risk is per contract, and that determines how many contracts you can hold. You have to sell. You know it's going lower. You see the bulls are trapped. The bulls are not making money. You can argue that we keep getting bad follow through after every bear bar, which is true. Bear bar doji, bear bar, bull reversal bar. But the channel is very tight, and therefore the odds are the market's going lower. So you have to sell. What's the easiest way to sell? Just sell at the market and put your stop where you know it has to go. Any one of these 3 stops is reasonable. If you choose a tighter stop, it's going to get hit more often, but the loss will be less than if you use a wider stop. But all 3 choices are reasonable, so choosing any is okay. After 10 trades, if you take the tight stop, you'll end up with about the same profit and loss as a trader who used the wider stop. Again, a type bear channel, they always look weak. They always look like they're about to reverse. But if it's a tight channel, very small pullbacks only brief, you have to get short. It's a breakout on a higher time frame chart. What's the difference between trading a type bear channel and trading a breakout? Well, one difference is if it's a breakout, it's much easier to sell at any time, including at the low. If it's a channel, a lot of traders do not like to sell at the low and they prefer to sell pullbacks, so they might be selling above the high of the prior bar. When the market's doing this, you know it's a bear trend. It's a very tight channel. If you were to draw channel lines, you'd see that the channel is very tight. The lines would be very close together. So you know it's going lower. For you to conclude that it's going lower, you have to be at least 60% certain. It never feels like 60%, but you know it's going lower. That means you are 60%. As a trader, 60% probability is as good as it's going to get, and you have to trade. You have to get short. And again, you could sell for any reason. Now, I talk about selling closes. When I say sell the close, what I mean is when the bar closes, you sell at the market and you get filled at the start of the next bar, or you sell a second or two before this bar closes at the market and you'll get filled right around the close of this bar. That's the easiest way to get short in a very strong bear trend. Every reversal is minor. That means every reversal will become either a bear flag and lead to lower prices, or a trading range and lead to lower prices. And therefore, if you see a reversal, it's going to fail, and you can sell a strong bull close, betting that the reversal up is minor and that it will fail. Again, if you cannot decide what to do, just sell at the market. Here, you can also sell on a stop below the low of a prior bar. We have a pullback, sell on a stop right below its low. It doesn't matter where you sold or for what reason you sold. You just look to the left for a major lower high or a significant top, and you can use your stop there. If it's a strong bear trend, it's not going to go above this high or that high or that high, and therefore any of them is reasonable. I'm going to talk about more ways to get short in the next video. I began by talking about scaling into longs in a bear channel. If the channel is tight, you should not be buying for any reason. Theoretically, it's often possible to make money scaling into longs in a bear trend, but it's a terrible idea, and experts do not do that. They do the opposite. They'll sell and maybe scale into shorts. Whenever I look at a chart and I'm thinking about placing a trade, I always look to the left. Have the bulls been making money pretty easily? And if it's very difficult for the bulls to make money, that makes me very confident that I have to sell and only sell. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading tight bear channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading in tight bear channels. When the market's in a tight bear channel, you have to get short, and I'm going to talk some about how to get short. I also want to talk a little bit about management, where to put your stops and how to take your profits. And then nothing goes on forever. Tight channels usually evolve into trading ranges. I want to talk about the signs that a channel is beginning to evolve. The market is in a pretty tight channel going down here. You have a spike down here and you're trying to reverse. You try to reverse, try to reverse, try to reverse. Channels are trying to reverse repeatedly. You have a spike, and as soon as you get a pullback, you're in a channel. Here we have a 6-bar breakout and then a pullback. So this is the start of a channel. We have another breakout and the channel is very tight. For this spike down, I would say this is the channel. So we have a very tight channel within a larger, very tight channel. One of the problems that beginners have is when they see these reversals with decent looking bull bars, they're afraid that the reversal will be major and turn into a bull trend. But the reality is that's not going to happen. These are all going to be minor reversals, and therefore there are opportunities to sell above the low, to sell at a better price. For beginners, the best thing they should be doing is entering with stops. When you see a reversal up, sell with the stop as the market's reversing down. It's always better to sell below a bear bar. So if you do not want to sell below this bull bar, wait for a bear bar and then sell. Remember, always in traders, if they get out for any reason, they have to sell again below a bear bar. So if an always in trader gets out above this bull bar, he's selling again below that bear bar. If an always in trader gets out above this bull bar, he's going to sell again below that bear bar, or below this bear bar, same thing. If a trader is trading always in and he thinks the setup is good enough so that he should get out and wait to see if the bulls will be successful, Once he sees that the bulls are not successful, he has to sell again. For me, that means selling below a bear bar. Also, if you think about it, if a bull buys above any of these bull bars, he's going to get out fairly quickly because he sees the channel is tight and he knows the probability of a successful reversal is small, and therefore he'll get out quickly. A good way for him to get out is below a bear bar. Therefore, selling low 1 and low 2 pullbacks in a tight bear channel is a very good strategy, very profitable strategy, because the bulls will give up. They're not going to be willing to hold on to a long very long when they know the channel is tight. They know that the odds are the market's going lower. Selling pullbacks to resistance makes sense. For example, the market broke to the downside. It traded down for a number of bars. Yes, it has a good bull bar here, a good bull bar here, another bull bar closing on its high here. However, this channel is tight as well, and the first reversal up is minor. That means it's either going to be a bear flag or it'll become part of a trading range. In either case, the odds are very high, 70%, that it's going down. Traders therefore look to sell a test of resistance. Here we broke out several bars below a prior low. The rally that we get is probably going to be a test of resistance, either the breakout point or the top of the most recent sell climax, the most recent major high or low. Traders will therefore sell there. They can do it with a limit order, placing a limit order to sell at that low, knowing that bulls who bought at this low and scaled in lower will be so afraid the bears are still strong once they see this channel. They're going to be happy to be able to get out, break even on their first short right here at the prior low, and with a minimum profit on their lower shorts. Therefore, the bulls will sell here, and the bears know that, and they will sell as well. More experienced traders see that a pullback here is only 1 bar, a pullback 1 bar, a pullback 1 bar. The pullbacks are very brief, and therefore they're going to sell at the high of the prior bar, betting that the pullback will only be 1 or 2 or 3 bars, and the bear trend will resume. They know the bulls are going to lose and that the bulls are going to have to sell out of their longs, probably at a price lower than where they bought. And therefore, the bears will sell exactly where the bulls bought, believing correctly that the market is not going to go much higher and that it will go lower. Selling pullbacks to resistance always makes sense. Typically, in any kind of a channel, once there's a new bear leg, bears look to sell around the middle third of that bear leg. A lot of bears like to sell a 50% pullback, and therefore, once you see the bear leg starting to reverse, some traders will place a limit order to sell at a 50% retracement and put a stop just above the high, believing that it's more likely the market will go to a new low than it is that it will go above their stop. The risk and reward is the same. The bears selling here are risking to just above that red line, and they're looking for a profit just below the prior low. But the probability is higher. Probability is 60% or more that it's going below here before it goes above here, and therefore the trader's equation is good. A lot of traders, when they're selling in a bear trend, will scale in higher. For example, if they sell at a 50% pullback, they might sell more 1 or 2 points higher. Traders should only be scaling in if their second entry is at least as big as a minimum scalp. In the E-mini, a minimum scalp is 1 point. Therefore, if a trader does sell here and he's thinking about scaling in, relying on his stop, his second entry should be 1 or 2 points above his first. Channel, a lot of pullbacks, so many opportunities to sell above the low. So instead of selling at the market at this very lowest price in the trend at that point, which is still okay because you know the market's going lower, you can probably sell at a higher price, like above the high of the prior bar. Any of these pullbacks is a good sell, and that allows you to sell above the lowest price. Again, any kind of resistance is a good location to sell. I don't have a moving average drawn in here, but a pullback to the moving average or a reversal down from the moving average is a good way to sell. Likewise, you can keep drawing trend lines And you can either sell at the trend line. Once you have 2 points, you can draw a trend line. You can sell at the trend line, or you can sell a reversal down from the trend line. We have a breakup of this trend line, but we can now draw another trend line, and therefore you can sell at that trend line or on a reversal down from that resistance. While you can sell at a prior low, betting on a breakout that goes down far enough for a profit, you get so many pullbacks, it's usually better to be selling above prior lows. And one of the reasons for that is in a channel, the bears often take partial profits at prior lows and then look to sell more on pullbacks. Here, the bears obviously did not take profits, or not many bears took profits. The market went quite a bit lower. And this is an example of selling with a stop just below the prior low being a profitable strategy. It's true for any of these. You could sell on a stop below this low, on a stop below that low, on a stop below this low. You're going to make money. The odds are 70% chance you're going to make money. Sell below this low, you get filled right here. You rely on your stop. The reversal is going to be minor. 70% chance it's not going to hit your stop and that you will make money. But if you did sell below this little doji bar and got filled here, you had to wait more than 10 bars before the market went your way. It's a strong bear trend, and therefore you can sell at any time, including after the market falls 6 or 7 bars. Therefore, this is a climax. You can sell at the bottom of a sell climax, confident that any reversal, even if it's strong, will be minor, and the market will come down to your price and probably lower. If you sell at the absolute worst price, the lowest bear close, you can sell more higher, confident that you'll be able to make money. If you take a sell right here, let's say you did choose to sell, there are 6 bear bars here, 7 bear bars here, and you sold the close of the final one. Your stop obviously is above the top of the most recent major lower high, which is the top of the sell climax, and it did not get hit. Most traders who take a sell like this are willing to scale in higher. A good way to do that is selling below a bear bar as long as the second entry is at least as big as a minimum scalp above the first entry. So if you sell this close, you see the reversal, pretty strong, then look to sell below a bear bar, again relying on that stop, knowing that the market probably will come down and test this close, allowing you to get out break even on your first entry, and then with the scalp profit on your higher entry. The bears who did sell here are obviously going to be disappointed by 4 bull bars closing on or near their highs. A very big pullback, very strong pullback after a climax. Therefore, you have big down, big up, generates big confusion, and the market will probably go sideways for 5 or 10 bars or more, which it did. These disappointed bears who sold here and saw this rally will be very happy to get out at their original close because they're thinking that the market might now be in a trading range. In any channel, tight or broad, you're going to get pullbacks. A lot of times they'll go a third or half of the way up of the prior bear leg, and that's where you want to sell. And that's true with the tight bear channel as well. For example, here's the most recent leg down. Traders will sell between a 1/3 pullback and a 50% pullback. This blue box is 1/3 of the way up, and this green box is 50% of the way up. So this is the sell zone, anywhere above a third, usually around a half, sometimes more than a half. Traders, therefore, will sell with limit orders. Some will sell with a limit order 1/3 of the way up. Others will sell with a limit order 50% of the way up. Others will wait until the market goes above 50% and then sell with a stop on a reversal down, especially below a bear bar. The reason why the channel is tight is because the reversals do not last long. They go up a bar or two and then the trend resumes. A couple bars up, the trend resumes. Here, 3 bars up and the trend resumes. Therefore, many bears will sell with a limit order at the high of the prior bar, even if it's a bull bar, betting that the reversal will only last 1, 2, or 3 bars. If it's only going to last 1 bar, like it did here, here, and here, you do not have a lot of opportunity to sell, and therefore selling at the high of the prior bar, betting that the pullback might only be 1 bar, is a very good way to sell. Sometimes, if traders think the buying pressure might be pretty good, instead of selling above the high of the prior bar, they'll wait for the market to pull back 1 bar and then sell above the high of that bar. For example, sell at the high of this bar, you get filled here on this bull bar. Other traders will look for 2-bar pullbacks and they'll sell above the high of the first pullback bar and get filled here. The same here. This bar pulled back above that bar. Some traders will place a limit order to sell above the high of the first pullback bar and get filled here. Other traders will sell the third pullback bar with a limit order above the high of the second pullback bar. They'd get filled here, or here, or here. This bull bar went above the bear bar, it's the first pullback bar. This bull bar went above that bull bar, it's the second pullback bar. This bar did not go above here. However, this bar did go above there, so this is the third pullback bar. You have many opportunities to sell for all kinds of reasons on all of these pullbacks. Traders choose one and they don't take all. They don't sell above the high of the prior bar. 1 bar higher, 2 bars higher, the 33% pullback, the 50% pullback, the reversal down, a strong bull close around the midpoint of the prior bear leg. These are all ways to get short. You do not take all of them, but you do try to take one of them. We have a 6-bar pullback, 4 decent bull bars closing on their highs. We went above the breakout point, and we have a big down, big up move. Those are all signs that the bear channel might soon be evolving into a trading range. Clearly, the bears are disappointed by 4 pretty good bull bars. Some bears will exit break even. Let's say they sold the low close and then they sold more higher for any reason. They might try to get out at the midpoint between their 2 entries with a small loss on their first entry, a small profit on their second entry, and break even on the trade. Now that this pullback went above that breakout point and we have a sell climax and a reasonably good reversal, bulls will begin to suspect that the market's in a trading range. We had a very strong bear breakout, yet the pullback went above the breakout point. What will bulls think about a new low? They'll think that trends tend to become weaker, and therefore, since this very strong breakout led to a pullback above the breakout point, if we get another breakout to a new low, chances are you'll get at least some kind of a rally. Bulls, therefore, will start looking to buy. They might buy with a limit order at this low and scale in lower, or they might buy on a reversal up, taking a chance that we'll get another reasonably good bounce like we did here. Placing stops correctly is very important, and you always have to be looking for reasons to take profits, because if you do not, they eventually will disappear. Whenever a market's in a bear trend, traders pay attention to strong breakouts to new lows. Here, we're in a bear trend, and we have a strong breakout below a prior low. Once you get that strong breakout, traders will trail their stops. By trail the stops, that means you move the stop from the prior major lower high to the new major lower high. And they do that throughout the bear trend. Pretty good breakout, pretty strong breakout to a new low. At that point, it's somewhere down here, traders will lower their stop right here. And that does not matter whether they sold up here initially and are still short, or if they sold right here. Once you see a strong breakout, your stop goes above the top of that high because that becomes a major lower high. Once you see a strong breakout, stop goes up here. Once you see a strong breakout, stop goes here. Strong breakout. Here, it's a strong breakout, not even to a new low. Traders would put their stop up here because at this point, they're afraid that maybe the market is transitioning into a trading range. In general, if you think the market's going to transition into a trading range, and it clearly is doing that here, you're not going to let your stop be hit. You're going to start trading it like a trading range, and you'll exit on a reversal up near the bottom and not rely on a stop above the top. Because when it's in a trading range, at some point, it's going to start going above prior highs, and you don't want to be giving back your profit, and you certainly don't want to be taking a loss, selling at a low and getting out above the high. Here we have a very tight channel. You know it's a breakout on a higher time frame chart. So at some point in here, you can lower your stop from here to above the top of this very tight channel. Is this a major breakout? Well, I don't know. I think we have a breakout to a new low. We have a couple of bear trend bars, but they're not particularly big, and we don't break strongly below that low, and there are just not that many big bars here. A lot of traders would consider this a minor low, and they would keep their stop either here or here. However, once you get this, 3, 4 bear bars closing on their lows, not much overlap, this is a major lower high, and traders would then put their stop here after they see these bars. What about bear scalpers? Where's their stop? Let's say you sold here and you're planning to exit with a couple points profit. It doesn't matter if you're scalping or swing trading, it's better to use a swing stop, especially if you're able to scale in. For example, let's say you sold the high of this bar for a scalp, looking for a 2-point scalp. It's better to have your stop up here and sell more a couple points higher than to use a very tight stop. Very tight stops lower the probability of making money, and a scalper needs a high probability. And usually that means he needs a wider stop, and he can increase his probability more if he's able to scale in. Beginners should not be scalping. Beginners should not be scaling in. Those are things that very experienced traders do. Most experienced traders don't even do that. They prefer to swing trade. It does not matter where you enter in a leg, you're going to be using the same stop. Whether you sold below this bear bar or sold here or sold up here and now the market's down here, as soon as you see a strong breakout, the stop goes above the top of this high because this then becomes a major lower high. The importance of a major lower high is the bears believe it's a bear trend as long as it keeps making major lower highs. Once it goes above a major lower high, then traders conclude that the bear trend has ended. It's then either in a trading range or possibly even in a bull trend. If you're selling based on the premise that it's a bear trend, and now you have evidence that it's not, you stop trading it like a bear trend. You start trading it like something else, like a trading range, or here, a very strong minor reversal. Traders start to look for a major trend reversal. Here, a higher low major trend reversal. You can also call it a head and shoulders bottom. We have a double bottom for the left shoulder, then we have a head, and now we are forming a right shoulder. Let's say a trader sold here or here, and now the market is down here. He's still going to use the same stop. The stop goes above the most recent major lower high here or here. Once the market is here, you could put a stop here or here. You could still use a stop here. You could still use a stop here, because we may get a broad channel, a pullback to 50% of the height of this sell-off, and then get another leg down. However, if the channel is very tight like this, the reversals probably will be minor, and therefore you do not have to risk that much. You do not have to use that wide stop. Once it starts to transition into a trading range, the first reversal up, even a big reversal like this, is still minor. However, once a trader sees a big minor reversal like this, he knows the odds are it's clearly in a trading range, and there's a 40% chance there may be a major reversal up on the next reversal. We have a strong bear breakout, a big bear bar closing on its low, and the breakout was confirmed by this next bar. It also has a bear close. This is the follow-through bar after the breakout, and when it has a bear close and the breakout is strong, it increases the probability that the market's going lower. And therefore, it's always reasonable to swing part of a short or all of the short. Most traders should be looking at this as a swing trade, looking for at least some kind of a measured move down, maybe based upon the height of the breakout, based on the height of the trading range, based upon the height of this leg down, gap, possibly measured move down. Once you see a strong breakout and follow through, there's a 60% probability that you're going to make a reward at least as big as your risk. If you sold this close and put a stop above the breakout bar, 60% chance you're going to fall that same distance to a profit target before you get above the high of that breakout. Initial risk. Some traders will put it at the top of the current bear leg. Other traders will simply put it at the top of the sell climax, knowing that if this is the start of a bear trend, high probability, 60 or 70%, it's not going to go above the high of the sell climax before going down. Once it went down, the trader who sold this close now knows that his actual risk was to one tick above the high of the pullback bar. So a very small actual risk. Let's say he put his initial stop right here. That was his initial risk. He was willing to risk between his entry price and that stop one tick above this bar, but it turned out he only had to risk to one tick above this bar. He did not know that at the time he put his trade on. But once the market started going down, he then knew that his risk was to just above the highest pullback after his entry. To have a positive trader's equation, all a trader has to do is take a profit that is at least 1 times bigger than his actual risk. If he sells here and it starts to go down, he now sees his actual risk is here. As long as he takes a profit that is as big as that risk, the math is good. It's a profitable strategy. If he does that 100 times, he will make money. He could therefore exit right here at 1 times his actual risk. If he does that consistently, every time he sees this setup, he will make money. However, he will not make much money. Look at the size of the trend to the left. Should he be going for a profit that small? No, of course not. Going for the minimum of anything in life is really the best choice. Hoping that you make the minimum wage, that's a terrible choice. Hoping that you get a D in school, terrible choice. When the actual risk is small and the trend is big, a lot of traders will not exit at 1 times actual risk. However, they might take partial profits at 1 times initial risk. Some traders had initial risk here, other traders had initial risk there. And that is a reasonable location for taking partial profits. So had you sold this close and put your stop above this sell climax, this is 1 times initial risk. That is a reasonable place to take profits. And look what happened. That tells you that a lot of traders did exactly that a lot of the bears took partial profits here. You're swing trading. This is not an obvious strong reversal. It's a minor reversal. And therefore, you should only take partial profits if you take any profits at all, because the odds are any reversal is going to be minor and the trend will continue down. Traders who put their stop 1 tick above the top of the bear leg had an initial risk from an entry price to the stop, and some of those traders will exit at 1 times that initial risk. And again, you can see what happened. That tells you that a lot of traders did exactly that. They took partial profits at 1 times their initial risk. Obviously, a lot of bears did that, and we got a pretty good bounce. The bulls knew the bears would do that, and therefore bull scalpers will buy there as well. When you have a high probability trade, which you always have in a trend, the math is always good to take partial or full profits at 1 or 2 times actual or initial risk and swing the remainder of your position. However, as I said, if the risk is too small, exiting at 1 times that does not make sense. It's a bad choice because you probably would make much more profit if you held on. A reasonable alternative to exiting at 1 times actual risk is to hold on to your entire position until there are at least 2 reasons to expect support. And then you could exit most or all, either with a limit order or a stop as the market reverses up. Every trend eventually ends, and it usually ends by evolving into a trading range. And then once in a trading range, the bulls hope to get a reversal up, and the bears hope that the trend eventually resumes down. We have a bear trend in a trading range, and now we're trying to reverse up. We don't yet know if it does reverse up, but we do know that it's no longer a tight bear channel at this point. You should trade it like a channel until it's clearly no longer a channel, and then you trade it like a trading range. Whenever any kind of a trend lasts 20 or more bars, you have to look for signs that it might soon evolve into a trading range. We have a bear breakout, and we got a measured move down. Therefore, this is a support level. We have a round number, 1870, just like 1880, 1890 is a round number. 1900 is a round number. We have a breakout above the top of a tight bear channel, and therefore we might start to be evolving into a trading range. We have a triangle, 3 pushes up, 1, pull back 2, pull back 3. Does not matter that this went below that. Anytime you see a trading range and it has 3 legs, especially if you get lower highs or higher lows, you can call it a triangle. Doesn't matter what you call it. What you have to realize is what the market's doing. It's becoming two-sided. Also, we're starting to see a lot of dojis and a lot of decent bull bars. Therefore, the bears are getting weaker. Limit order bulls are making money. Buying below this low and scaling in, they made money. Buying at this low, they made money. The biggest bear bar in the entire bear trend. Anytime you see the biggest bear bar occurring 20 or more bars into a bear trend, here, maybe 60 bars into a bear trend, it's more likely that it's an exhaustive end of the move than the start of an even stronger leg down. We have a nested high 2 buy. There's a high 1, pullback, high 2. This did not work. It became a 2-legged move down to a bigger high 2. So 2 legs down, 1 pullback, 2. Trading ranges often have 2 legs down, 2 legs up. We have a strong bull reversal at the bottom of a channel, and the channel is getting flatter. A very steep channel here, a flatter channel here. Strong reversal up. 2 consecutive bull bars, probably always in long and probably going at least a little bit higher, maybe a measured move up based upon the height of those 2 bull bars, which it did reach here. As soon as you decide the market's always in long, for example, by the close of this bull bar, if you're short, it's always better just to get out because the reversal could go a lot further than what you think. So if you did not get out for any other reason, once you see the market is always in long, you exit. You can just buy back your shorts at the market. If you are short, let's say you shorted here, and you're starting to get good reasons to suspect that the market's no longer in a bear channel and has evolved into a trading range, that is a good reason to take your final profits. Whenever you think the trend has ended, the odds are you're going to get 10 bars, 2 legs, sideways to up. You're going to get a TBTL pullback, 10 bars, 2 legs, pullback. Big consecutive bull bars closing on their highs, very little overlap. The market's always in long. That tells you that the bears are giving up. The bears have decided that the bear trend has ended, and it's now either in a trading range, possibly in a bull trend. This is a sign that the bears are giving up. It's also a sign that the bulls are getting very aggressive, confident that the bear trend has ended, and we might now be either in a trading range that could go up a long way, or possibly even in a bull trend. Major lower high, and we broke above it, and then we broke strongly above it. The remaining bears are buying back their shorts in a panic. Most bears exited earlier, but the remaining bears are giving up here. And then you also have bulls who are buying as well. The bears are buying back their shorts. The bulls are buying as well, betting that at worst it's now a trading range. And if it's a trading range, chances are it will not fall much below this low, and they can buy more lower. So they're willing to buy every strong bull close, knowing that it's either going to go up into a bull trend and then they'll make money, or it'll go down and not fall much below this, they can buy more lower, expecting it to come back up here, and then they get out break even on their first entry, a profit on their second entry. Therefore, it's a profitable strategy to buy here if you're able to use a wide stop and scale in. The bulls bought all the way up, knowing that eventually there would be a pullback, maybe a deep pullback and a trading range, but there might not be a pullback and it might go straight up. If there was a deep pullback and they managed their trades correctly, they could avoid a loss. So buying for any reason at any moment is a logical strategy. Most bulls are not going to buy this high. Third push up, one pullback, two pullback, three, 50% pullback in a bear trend. However, some will. Bulls are buying to get long. Bears are buying to get out of shorts. We have an exhaustive sell climax. The gap between the high of this pullback bar and this low, this low, this low probably is an exhaustion gap. The market's probably going to go above those lows. It's probably going above the top of this final sell climax bar, an exhaustion gap bar. And therefore, bulls will buy for any reason, and the bears should be getting out as well. For example, as soon as they see this big bull bar, they might place a stop to buy back their shorts one tick above its high. Big down, big up, big confusion, at a minimum, sideways. Context is good enough for a reversal. By the close of a second consecutive bull bar after a sell climax and a possible final flag, traders have to get out. I would always get out in this situation because it's no longer a bear trend and the odds are we're going up for some kind of a measured move. We might pull back a little bit first, but the odds are we're going higher and it's no longer a bear trend. It's probably a trading range and it might even be a bull trend. If it's no longer a bear channel, I don't want to be treating it like a bear channel. We have a bear breakout and then another bear breakout. We have one push down, two pushes down, three pushes down, four pushes down. This is a wedge higher low. Look at the reversals here. This is a weak bear leg after a very strong bull leg. This is therefore probably a bear leg in what will become a trading range, and it might also be a higher low major trend reversal that could lead to a big bull trend. Therefore, bulls will buy a reversal up, especially above a decent looking bull bar. One obvious sign that a channel is weakening is that you're starting to get repeated rallies above the bear trend line. That makes the trend wider and less steep, which means less strong, and you have to assume it'll eventually be so weak that it will be a trading range. A bear trend, we broke above the trend line. You can draw a new trend line, and then we broke above this line. This line is flatter, so the channel is becoming less steep, less strong. And you can keep drawing lines, and the lines are getting flatter and flatter and flatter. And eventually the market is in a trading range. We do have a trading range here already, and then this became a bigger trading range. You could argue that the trading range began here. Spike, pullback, channel. Usually the channel becomes a trading range. You can see this high tested near the top of that channel. Any trend that goes on about 20 bars or more often will start to have signs that it's transitioning into a trading range. And therefore, after a trend lasts about 20 bars or so, you should be aware that it might evolve into a trading range. If the trend looks like this, there's no sign that it's evolving into a trading range. It's still a very tight bear channel, and you should only be looking to sell. However, when you're starting to get stronger bull legs like this, it's still a channel. However, it's probably soon evolving into a trading range. We have a trading range here for about 20 bars. However, it's a pause in a very strong bear trend, and the first pause, the first trading range, is likely to have trend resumption down, which it has here, but it immediately reversed up. A trading range late in a bear trend usually becomes the final bear flag, which means that the breakout below that trading range usually does not last long. 1 bar, 5 bars, and then it reverses, and the market then enters a trading range. At some point in here, you have to conclude the market is in a trading range and no longer in a bear trend, and therefore you have to trade it like a trading range. You have to be looking to buy low, sell high, and scalp. Through here, the probability of lower prices was 60%, 60%. But once you start to go sideways, that's not the case anymore. 50% chance we'll get a bear breakout, 50% chance we'll get a bull reversal. And at this point, we do not know which will happen. We have a higher or low major trend reversal, but for the bears, they're hoping it's simply now a broader bear channel, deeper pullbacks, but continuing down. We don't know. 50-50 chance it'll go up, 50-50 chance it'll continue down. Even a very tight bear channel eventually is going to evolve into a trading range. 75% of all channels have a bull breakout, and the market then becomes a trading range. Only 25% of bear channels have successful bear breakouts and even stronger legs down. Here, we tried to get this strong bear breakout late in a bear channel. It failed. It only had a 25% chance of success. 75% chance it would reverse and become either a trading range or a bull trend. As I mentioned a moment ago, sometimes you can get a very strong rally and the market becomes always in long, yet you can get a new low and then another strong rally and another new low. Then you have a broad bear channel. Even then, the odds are it's going to eventually evolve into a trading range. Very tight bear channel. Still a tight bear channel. This bear channel is within this bear channel. You can draw it this way, and it's still a fairly tight bear channel at this point. I began by talking about different ways to get short when you have a tight bear channel. I then talked about the importance of a stop location above a major high or low, and the importance of taking profits because all trends eventually end. They typically evolve into trading ranges, and you have to be taking profits because you don't want to be trading the market like a trend when it's no longer a trend. If you do, you will give back all of your profits. Every channel, even a tight channel, eventually evolves into a trading range. And therefore, if you see signs that it's evolving into a trading range, stop trading it like a bear trend and begin to trade it like a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading tight bear channels.